Hello, my name is Derek Afasi. I'm the owner of Afasi Financial Group based out of here in Tampa, Florida. We discuss different things with the video tutorials and literature pieces that we give you through this website. Today we're going to be discussing the cash value of life insurance. Now, this is something that is available to supplement your retirement. The main purpose, and this is on the non-qualified side, definitely look at that video as well, the difference between qualified and non-qualified accounts. This kind of goes into a little bit more of the intricate details of how cash value of life insurance comes out tax-free and why it is on the non-qualified side. Basically, you have these plans, different pros. The way that the cash value has different pros, and then I'm going to kind of conceptualize how a life insurance policy works. Pros of this is it grows tax deferred. Your money goes in, it puts money towards the cost of insurance, and then a little additional premium is going to be into something equivalent to a savings account. How that savings account, how that interest is computed, depends on exactly which plan you decide to choose. So, but it ultimately grows tax deferred. The more money you put in, whatever different interest crediting rate it goes by, is going to obviously make your bucket grow a little bit more and more. So every year that it grows, Uncle Sam can't touch his money, allowing for the power of compound interest and tax deferred growth as a plus. It is tax-free. Just like a Roth IRA, it's 100% tax-free. You're putting money in, you're not getting your tax deduction because it's on the non-qualified side. But when you do ultimately want to start taking those distributions, it's going to come out to you tax-free. There's a 59.5 rule that does not exist. This is under the house of life insurance. That's generally where you're hiding your assets under, is the house of life insurance. And it goes by different taxation, and doesn't necessarily have to be on the books of the IRS when you do your tax at the end of the year. So ultimately, if you're contributing into this plan, it's, you started up when you're 25 years old, you've been contributing for 15 years, you're age 40, something happens, you could take money from the cash value. The way you take it out is a little bit more, it's a little bit more specific on how to make sure that it does come out tax-free, so definitely give us a call, we'll help you out in regards to that. And that's one thing that is very, very huge whenever you're dealing with an advisor. They have to know exactly how to take out those distributions properly. Because if not, it could end up it could result in a taxable form. Tax-free distributions. Tax-free death benefit. Ultimately, this is life insurance. Life insurance is tax-free. Excellent. It's a living will. It constitutes as a living will. When you do receive your money, as opposed to all the other plans, where you have to pay taxes, income in respect to the decedent, any of the gains, or depending if it was a qualified plan, you'd have to pay full taxes on that, whoever is designated as beneficiaries. With life insurance, it's going to be 100% tax-free, whatever that death benefit is. You could attach certain waivers on there. Now, a waiver is just basically saying if you constitute something in the risk management-based realm, if you become disabled, we could tie a disability waiver to it. How are you going to fund your premiums into this policy if you became disabled? You can't. So that's ultimately where the insurance company pays the premium for you. Depending on your age, it could be something 50 cents a month extra, $3 a month extra. Obviously, the older you get, the more apt you are to becoming disabled, so they're going to correlate that perfectly to exactly your age. Long-term care waiver, depending upon the state, there are some that have long-term care waivers. If you are, and definitely check out that video as well in regards to long-term care. If you have any needs for long-term care, they'll give you access, or they'll at least allow you to take some of the cash value out, to allow you to take some of the death benefit out, where you could take that tax-free and you could use it towards the cost of long-term care. Now, there's a lot of cons, just like everything else that we've went across. There's a lot of cons, and this definitely holds true, and you have to make sure that if you try to accumulate assets and supplement your retirement income with nice tax-free, tax-deductible, tax-favored growth, you could do it in the right way, but you have to understand these cons. You're not going to get a match because this is going to be your own individualized plan. If you jump around from company to company to company, this plan stays with you. You're not matching yourself. So it works the same way as an individual retirement account, but this is your own policy. It's not a group insurance, it's your own insurance. No tax deduction because it is on the non-qualified side. You're not getting that tax deduction because ultimately as your assets accumulate, it's going to be tax-free. Also, it doesn't work if you're too old and you're unhealthy. depending on the company and depending on the age, money goes in and the cost of insurance will be extremely, extremely high. A lot of reps sell this the complete wrong way. They say, oh, no, this is great. We're going to make sure that your cash value is excellent. We're going to show you phony projections of 13, 20% projections of money that's going to grow your cash value, and that's the type of returns you're going to get. But if the person's too old, they're too old. This isn't an alternative for them. There's different types of life insurance out there, and definitely look at that video as well. And it kind of breaks down exactly which one is permanent, which one grows cash value, or which one that you don't care about cash value. Because ultimately there's a cost to cash value. You're putting in more money than what the cost of insurance actually is. So you can't be too old and you can't be unhealthy. If somebody comes to us and they say, okay, they want to leverage some of their assets, they want to try putting in money towards a life insurance policy to build some cash value, we're going to make sure that they go through underwriting, that they go through a medical, that there's no ailments, because ultimately you want to make sure that that cost of insurance is as low as possible. Unfortunately, like I said before, a lot of the agents sell it where the cost of insurance is so great, the cash value is so minimal. Basically, with a life insurance policy, how it works is you have your premiums. Your premiums go in to cash value. The way that cash value accumulates is based on different interest and credits. It could be based in mutual funds. It could be based to an index that could go up. It could never decrease. It mimics a certain index such as an S&P 500, Dow Jones Industrial. You could have it tied to interest rates. You could have it tied back by the company. So there's different ways on how this cash value accumulates. Now, as you see, cash value is right over here. You have access to the cash value at any time. You could take that in the form of distributions of the amount of money, your cost basis, what you paid in, or you could take it out in the form of loans where you could have zero net loans and it could come out to you tax-free. But it all depends on exactly what you're trying to accomplish, and each company is different when it comes to the loan values and exactly how to take the distributions. So you do have to talk to a licensed professional when doing that. Give us a call to one of our retirement specialists. We'll be able to help you out in regards to how to access your cash value, exactly how to explain all the intricate details of that particular company. Cost of insurance, we want to make sure that the amount of money you're putting in, the cost of insurance is as small as possible. That being as small as possible, we want to try to overfund these policies so that majority of the money is going to pay for the cash value. Now, within the first years, from years 1 to 10, a lot of your insurance costs are going to be the most expensive. It pays for administrative fees. It pays for a lot of the different death benefits of people that own policies before you within that company. So that's ultimately when your money is growing in there and you are overfunding it. Rule of thumb is right around the 10-year mark. The amount of money you put in the cash value is about equivalent. If you are going and you're accumulating these assets and then all of a sudden you die prematurely, you have a tax-free death benefit. Gets paid out to any of your beneficiaries, any of your dependents, and it definitely helps. There's a video that we have that says covering all your bases, and it kind of talks about the 3 scenarios of the reality of retirement planning. In regards to that, we said scenario 1 is you start accumulating your assets, you see it through to retirement, everything looks great. Scenario 2 is then you retire properly. Scenario 2 is you start accumulating your assets, all of a sudden you become disabled. How are you going to fund your comfortable retirement if you became disabled? You could attach a disability waiver to it. But ultimately what this says is you're not going to be able to pay the premiums because you're disabled, so we'll pay the premiums for you. And your money will go in, cash value will grow, and ultimately could act as part of supplementing your retirement. Or the third option is you set up a plan, everything looks good, you die prematurely, and now your dependents that were relying on your income are left without financial adequate support. So when you do this the right way and you're young and you're healthy, you can really get all 3 scenarios of the retirement, 3 scenarios of the reality of retirement plan. You could have that all taken care of in one fair swoop. But you do have to understand exactly if it does have to do with your particular situation. A lot of the medical professionals like these policies because there is no max contributions. If you make $500,000 a year and you want to put $100,000 into these policies, you can. But you have to do it within the terms of something called a modified endowment contract. You have to make sure that there's a complete correlation between cash value growth and death benefit growth. As cash value goes up, it's going to hit a threshold, and death benefit's going to have to go along with it. So you can't go and dump a lump sum of $100,000 into this policy and take out a $5,000 policy. You have to make sure that you're staying within the terms of the IRS, within the terms of taxation, because you get hit with a taxable event. That's basically it. You do want to make sure that you are doing this the proper way, that you're funding as much into the cash value as possible, allow it to accumulate. There's different options with how that cash value accumulates depending upon your risk tolerance, which you like. You have whole life, variable universal life, indexed universal life. There's a lot of different scenarios that you could do to kind of help you attain some of these assets. Like I said, there's just generalized information. Remember, your situation is different from everyone else's in regards of your occupation, your family, your financial goals, whatever it is. But to get help, just give us a call. We have a toll-free number. You can contact us depending upon your preference. You can contact us through the toll-free number. You could contact us through email. 24 hours a day, 7 days a week, we'll contact you. Or you could even set up a teleconference and you could see our face. We'll send you some literature pieces, something that we'll try to be as intricate as possible to make sure that you understand everything fully. Thank you very much. This is the cash value of life insurance, a little bit of how it works. Give us a call. Once again, my name is Derek Afasi. Thank you.